Okay, so we are going to talk about some of the required disclosures public companies make. And the truth is there are a lot of these. And there's many reasons why they might be generated. So, for example, if I am an investor and I purchase a significant share of a company, so for example, let's imagine that I'm Porsche and I decide to buy 10% of Volkswagen. If Porsche were a U.S. company and if Volkswagen were a U.S. company, then Porsche would be required to disclose that they are now a 10% owner in a form to the SEC that's then made public on the SEC website. And there's actually different paperwork depending on whether you intend to passively hold the block of shares of the other company or if you tend to use the block that you've acquired to force changes at the other company. This is in fact something that happened. Porsche did buy a large portion of the shares of Volkswagen in an attempt to ultimately take it over, which failed and resulted in the minnow eating the shark. Can't really talk about Volkswagen being a minnow, but it ended up not going well for Porsche. Those would be 13D and 13G filings. There's also Form 4s where insiders like executives, board members, family members of important decision makers, that kind of thing, if they make large transactions, then those sales are reported on a Form 4. So there are tons of those, and they're watched closely by people who follow the stock of large companies. The annual investor materials. So if you attend the shareholder meeting of a company and vote on shareholder proposals, you're given materials to help you make your decision and or send in your ballot by proxy. And those materials are required disclosures by the SEC and are available on the website. And then most importantly for us are audited financial statements. Like the statement of cash flows and a statement of stockholders' equity and a balance sheet and an income statement. Most important for us are balance sheet and income statement, and so we'll go into a little bit more detail about those. The proxies that contain the description of proposals given to the board are they're called definitive 14A is the name of the proxy. And then if you amend them, you get a definitive 14AA because it's an amended 14A. Those are really kind of a goldmine of interesting things to look at. For example, I've done research on the executive performance metrics that are disclosed by the board. And you can see a significant difference in the way firms that award their CEO bonus based on accounting performance versus firms that award their CEO bonus based on stock price performance. But let's look specifically at some financial statements of a particular company. So we're going to use the company Techne. It's a biological products firm from Minneapolis, Minnesota, as our example. So the financial statements are the ones we're most interested in. They're actually released in two versions. You have an annual version that covers the year-end results, and there's a quarterly version that covers just the most recent quarter. And obviously, there's a delay to help for the company to have time to prepare those statements. And then sometimes they're amended after the fact if there's a need to. So the balance sheet is really a snapshot of the state of the firm. You think just like a picture, right? So at a particular moment in time, this is how much money was in all the separate accounts. This is how much was in inventory. This is how many collections were outstanding. What's the level of our short-term debt? How much do we owe on the electric bill? I mean, it's really all of these different things aggregated up into some categories, and it's just a picture of the current status of the firm as of the snapshot. So that's the balance sheet. So a picture is like a metaphor for the balance sheet. The metaphor for the income statement is a video of the last year or quarter of the firm. So if we had to summarize what happened over the last year, we could track things like sales, how much did we spend on goods to sell, how much did we spend on administrative expenses, things like that. So naturally these things interact, right? Because if I have significant sales that cost me more to sell, if I purchased things and then sold them for less than I purchased them for over the course of a year, this is going to be a drain on the cash accounts. And then when I take a picture of the firm, it will have less cash because we were selling goods over the course of the year at a loss. So the balance sheet and the income statement interact, and often when we are doing ratio analysis, we're thinking about how do maybe good things in the income statement relate to expensive things in the balance sheet. So if I need inventory to fuel my sales, how effectively am I using inventory to produce sales? Or how effectively am I using property, plant, and equipment to produce income? So often our ratios that we look at will be a comparison of an income statement item to a balance sheet item. Not always, but frequently. The balance sheet is organized from the most liquid assets to the least liquid. Liquid in finance is a term meaning convertible to cash. So if you have a Culver's gift card. Culver's is a delicious hamburger restaurant in the Midwest, but they've spread west and east a little bit. If I have a Culver's gift card, that would be fairly easy to convert to cash if I'm in the Midwest, and it'd be a little bit more difficult to convert to cash if I'm in Egypt, but it would be definitely less difficult than converting, say, a personal residence to cash, right? So there's levels of liquid, and then balance sheet is sort of sorted from most liquid cash itself to least liquid intangible assets. There's also a division between current assets and non-current assets. Current assets would be assets that would generally be considered convertible to cash within a year. So if I have inventory, usually I'm able to turn that inventory into cash within 12 months. And so that is treated differently than, say, a factory that we own, which might take a significant length of time to sell. So an important quantity is net working capital, which is the difference between current assets and current liabilities. And we want this number to be small typically because if it's large and positive, that's money we've had to invest in the business. That's then tied up working for the business. And so and because that money could have been invested at an interest rate, there's a real dollar cost to having large net working capital. The income statement we should be familiar with because we've been making them. Right? It starts with sales and works its way down: variable cost, fixed cost, interest, depreciation, tax, and then ultimately ending in net income. And the different levels of the subtotals have important meaning. So and we have a phrase for it, so we could say a company is EBITDA profitable. And if a company is EBITDA profitable, if they have no debt, that means that company may never pay its investors a return reasonable for the money they put in, but it's not necessarily going to die, right? They're making money. They're making money enough to purchase new goods to sell again or to continue their services, but they're not producing any money for the investors. They're just sort of puttering along, existing. But a problem, though, is that if depreciation exists, then the equipment that is being used to produce the small but positive EBITDA may at some point break, and then there's not going to be any money to replace it, and there's not going to be any interested investors to kick money in. So really, an EBITDA profitable firm should be fine in the short term as long as they don't have to pay any interest, but in the long term they may run into trouble and then they won't be able to afford to replace their equipment. Now, an EBIT profitable firm is able to funnel the profits that they have into an account enough to overcome depreciation, and so that would mean on average that an EBIT profitable firm would be able to replace necessary assets. So the firm may never give any money to investors, but it will have enough money to replace the things it needs to exist, and so it will alleviate some of that long-term problem of what happens to the assets when they run down. So obviously, an EBIT profitable firm has a better survival probability than just an EBITDA profitable firm. And then lastly, net income greater than zero means that there was value created for the shareholders after controlling for everything else, including interest payments, but it may not be available as cash. So often we might have generated a bunch of value, but it could be tied up in the equity in the business or in maybe bills that people owe us, that kind of thing. So we measure value, and the shareholders can appreciate it, but it may not show up to them as cash yet, but it might. It depends on the nature of the business. Okay, so let's take a look at the financial statements from Techne and decide if we think they are profitable, sustainable, how big they are, what industry they're in, and are they growing? So let's answer the big question first. So a good way to think about size of a company is annual sales. So if you look at annual sales for Techne, in these statements, these are 2011 statements, we have net sales of just under $300 million. So why did I say million? So if you notice there in the upper left-hand corner, it says that the income statement is in thousands. And this is almost universally true for income statements. For larger firms, it might even be in millions, but if you list your income statement in dollars rather than in thousands of dollars, it's considered poor form and might even be considered, borderline unethical, because no one expects dollar for dollar income statements. It'd be like almost a misrepresentation of the size of your business. So this is a significant enterprise, almost $300 million in sales. Another way to look at size is to think about total assets. So if we go here into the balance sheet, we have total assets of $620 million. And so that just is also indicative of how big the firm is. So it's a large firm, but for a public firm, that's not particularly big. And obviously, it's going to be significantly smaller than than companies you may have heard of, like Walmart or Target or American Airlines. So are they profitable, sustainable? Okay, so let's answer profitable first. So a natural place to go for profitable would be the income statement. And you can see it kind of follows our formats. We have sales. Cost of sales is their variable costs, and they have some fixed costs broken out, but under operating expenses, we have that 61 or just about $62 million of operating expenses. That would be like Techni's fixed costs. You can definitely observe after looking at lots of these things that there's not really a particular format that these follow. Every firm is different because every industry is different. So, for example, if you think about Hertz Rent-A-Car, it doesn't necessarily make sense for them to even have inventory. Right? They have car inventory, but it's not to sell, it's to rent. So it's not really inventory in the sense that we think of where there's product on shelves that moves. And so they wouldn't even have an inventory line on their balance sheet. And they wouldn't really have cost of goods sold either because they're not buying things to sell again. And so there's, for any given line in an income statement or balance sheet, there's probably a firm that it doesn't make sense to apply it to. But if we look at Techni, we have some variable costs, we have fixed costs, and then there's some just a couple random other things involving interest, and we get to EBIT right there at 165 million, and then tax of 52.5, and so we have net earnings of 112 million. So if you look at that, we've got 112 million in earnings on 290 million in sales. That's pretty profitable. Right? That's a very high profit margin compared to something like your grocery store where you might see 3%. And we can ask the sustainable question. It would be better if we had more than 3 years of data, but just looking at what we have, we go from 105 to 110 to 112. It seems like a steady, stable growth in earnings. And so, at least based on the data we have, they appear to be profitable and sustainable. What industry they're biological products, and then are they growing? And we answered that yes, right? The earnings are growing. We can look at that a couple different ways. Assets have gotten bigger, and so the firm is growing. Okay, if you want, so here are just some instructions to get the most recent data for Techni. They release financial statements within a couple months at the end of their fiscal year every year, these are all freely available on the SEC. It's a great source of data for doing research on companies you're interested in. I've obviously spent a lot of time there, being a corporate finance researcher, and they make improvements to make it more user friendly. In fact, they have there's actually a language. It's called the Extensible Business Reporting Language. It's like an XML spec that's specifically for reporting financial data, which is pretty cool. But let's take a look at some other firms. So this is Walmart here. You can see these are now in millions. So basically Walmart is 1,000 times bigger than our friend Techni. And so Walmart has 443 or 444 billion in sales. And the income is 24 billion. So you can see in percentage terms, it's a lot lower. Walmart has lower profit margins than Techni does. If we look at the assets of Walmart, they have 193 billion in assets. And so if you remember, right, the sales, or Techni's sales, were significantly smaller than their assets, while Walmart has sales are significantly bigger than assets. So how can this be? Well, if you think about Walmart, right, it's basically a giant box full of stuff that turns over as fast as possible. And so, big empty concrete boxes don't necessarily add up to a lot of money relative to the quantity of goods that flow through. Whereas Techni might have things like research labs and offices to house research staff and all those kind of things. So they compared to a Walmart might have a lot, clearly have more invested in assets per dollar of sales than Walmart does. I also have Google, just for comparison. So this is the Google balance sheet here. So So total assets is 72 billion. That's significantly less than the 200 billion of Walmart. If you look at revenue, they have $38 billion of revenue and $10 billion of net income. So that's more like a Techne number, but it's in between the Walmart percentage and the Techne percentage. But we're kind of hand waving here, right? It would be nice to be more systematic and to have specific ways to compare these kinds of things. And so that's where ratio analysis comes in. So when we come back, we'll talk about how to use balance sheets and income statements in a ratio format to assess different kinds of things we might want to know about companies in general.